Good morning and welcome to the Weekly Insight with John Plassard by Cité Gestion. For several years now, investors have learned to navigate an environment dominated by a single issue, inflation. But with the war in Iran and the surge in oil prices, a more complex concern is reappearing in markets and among central banks: stagflation. Stagflation is probably the most feared economic scenario because it combines two phenomena that normally should not coexist: high inflation and weak economic growth. The energy shock linked to tensions in the Middle East is reigniting this risk. When oil prices spike, production costs increase, corporate margins are squeezed, and household purchasing power declines. In other words, economic activity slows as prices continue to rise. This is precisely the dilemma now facing central banks. If inflation accelerates again because of higher energy prices, policymakers cannot cut interest rates as quickly as expected. Yet if growth weakens at the same time, keeping rates high also becomes risky. Markets are not yet openly talking about stagflation, but they are beginning to factor this possibility into expectations. Investors are closely watching oil prices, inflation, and how central banks might react. If energy prices remain elevated too long, expected rate cuts could be delayed and activity could weaken. Historically, the main reference remains the stagflation of the 70s. The oil embargo imposed by Middle Eastern producers triggered a surge in energy prices, an economic slowdown, and volatility in financial markets. For investors, this period reshaped asset allocation strategies. Equities struggled to keep pace with inflation, eroding purchasing power. In contrast, commodities, particularly gold, oil, and industrial metals, performed strongly while the US dollar weakened against major currencies. Traditional safe havens such as government bonds and cash proved less attractive because inflation eroded real returns. Investors therefore turned toward alternative assets such as commodities, real estate, foreign bonds, and inflation-linked securities. Today, stagflation is not the central scenario. However, the combination of geopolitical tensions, rising energy prices, and slower growth reminds markets this risk never disappears. For markets, the key question is not simply the level of oil prices, but how long this energy shock will last. Duration, more than price, will determine whether the geopolitical crisis remains temporary or becomes a genuine stagflation risk. Thank you very much. Have a great week, stay safe, and keep on winning.